So the market is doing that thing again where it goes down and everyone freaks out. The S&P 500 is down almost 5% in just a week. And if you're invested in individual AI stocks like Nvidia, congratulations, your portfolio just took a 20% nosedive. But before you start Googling, should I sell everything in a panic? Let's just take a breath and remember one thing. The market likes to mess with you. History shows us that these wild market swings are part of a bigger picture. So let's chill out for a second and talk about why staying invested is so important. Trying to time the market is like trying to predict whether your cat's going to decide to be affectionate. It's impossible, and honestly, you're probably just going to get scratched. Sure, when markets drop, you think, hey, maybe I should pull out for a while, create a cash stockpile, just like Warren Buffett. And that's what a lot of people do at times like this. And it's almost always the main thing people get wrong when they invest. And there's lots of evidence to prove why, so let's look at it. Here we have a nice chart provided by Morningstar to demonstrate the point. It represents a 20-year investment period, and the main focus of it is the global financial crisis of 2008. And if there were ever a time in modern history where a lot of investors panicked, then this was it. So obviously, the really stupid move here would be to panic so hard you sold all of your investments during the crash and were so traumatized by the whole thing that you never invested again. That scenario is shown in this bottom kind of muddy blue coloured line, which basically just continues to rise very slowly in line with your bank's saving rate. Pretty underwhelming. And since you're watching this video, you probably have no intentions of doing this because you're an investor. But where it gets interesting is this goldy yellow coloured line. In this scenario, the investor got a bit spooked and decided to sell out after the downturn hit. Then they gave themselves a year to reflect on all the bad decisions they made and eventually plucked up the courage to invest back into the market a year after leaving. 12 years later, and they have a nice sum of $443,000. But the top scenario, represented by the light blue line, shows the situation of the chilled out investor, the guy who experienced the market crash but didn't panic. This investor stayed invested all throughout, and as a result, benefited from the post-it rally that inevitably happens whenever the market crashes. They end up with $578,000, which is 30% more than the investor who left for a year, and 58% more than the guy who decided investing was just far too risky and is now regretting all of his life decisions. Pretty interesting stuff, but what I really want to emphasize here is that this chart shows a 20-year period, and the gold investor only exited the market for 1 year in that 20, but that 1 year exit resulted in a 30% decrease of what they could have had. And the reality is, this is exactly what loads of retail investors do. The market falls, they get spooked, they sell their shares, and then they reinvest after the upturn has already begun. Now, before you start going all Warren Buffett and decide that in the future you'll simply sell at the top and buy at the bottom, let me show you why that's not as good an idea as it sounds. For a start, it's extremely difficult. In fact, unless you have a time machine, it's impossible. But let's say we did have a time machine, and then let's look at this chart. All these investors invest 60k over a 20-year period, except this guy who just leaves it in cash, and then again at the end of the 20 years, regrets all of his life decisions. This dude in the light blue is very bad at timing the market. He manages to invest his yearly fund at the worst possible time every single year, aka when the market is at its peak. Whereas this guy in the dark blue is either a time traveller or a market genius because he invests at the best time every year, which is when the market is at its lowest. Our golden boy here doesn't have a time travelling device and also knows he's not a genius, so he simply dollar cost averages his investments every month of every year. What's incredible about this data is it shows that even if you had perfectly timed the market over a 20-year period, which is basically impossible, you only end up 12.5% better off than the guy who just dollar cost averaged the entire time. It's a lovely example that it's good companies that result in investment returns. Timing the market is nowhere near as important as choosing a diverse portfolio of strong companies. And for those investors currently getting the jitters about the recent all-time market highs, this chart will surely calm your nerves right down. This blue line shows someone who stayed invested constantly from 1926 to 2023, and despite being an extremely old individual, they've done pretty well, with around $5 to $10 turning into $85,000, a lovely gift to themselves for their 111th birthday. The green investor, however, took a different approach. This investor sold their stocks following any month where the market hit an all-time high. Then they reinvested the money whenever the previous month wasn't at an all-time high. Essentially, they just spent 100 years worrying that the market was overpriced, resulting in a measly $8,700, 90% less than the dedicated investor, and barely enough to get a decent stair lift installed. And this chart doesn't even take into account transaction costs, which would actually make the green investor's results even worse. Staying invested during market downturns is like watching Breaking Bad. The first couple of seasons are slow, but you've got to stick with it because it's all rapidly uphill from there. Sure, market dips feel like the worst when they're happening, but they're always followed by recoveries, and trying to time the ups and downs is a one-way ticket to regret. In fact, the average bull market lasts around 59 months, with 169% gains, whereas bear markets only last around 10 months, with around 35% declines. So just make sure you have a balanced portfolio of strong companies and keep on investing. The market will mess with you, but if you stay the course, you'll win in the end. And if you want help finding great companies, you can gain access to our stock analysis dashboard on our website. It helps you identify companies that fit with the criteria we've developed based on the strategies of legendary investors, and compares their metrics to other companies in their industry to help you easily spot their strengths and weaknesses. You won't regret it.